Okay, so today we're going to talk about the chaos that we've seen in the UK bond markets this week and try and answer the question why. So a little bit of the background. So a pension fund, as many people probably know, they will take in payments from people that are working, and then they will also pay out, and this is termed a liability, to the people that have retired, so the pensioners. Now, a pension fund doesn't just take in the cash and sit on that and then pass it through. What it will attempt to do is to invest that money to beat inflation and also to create growth, so that in the future the payments going in will then be invested to a point where they'll meet commitments for pensions that have got defined benefits. So, for example, people can take a pension out where they know what the income will be at the point of retirement on a particular date. Now, two main investments that pension funds make are bonds and equity shares. So an equity share would be, for example, shares in IBM. Right, so we're going to focus on bonds today because interest rates and inflation are important factors in what happened or what's been happening within the bond markets. So a bond is effectively an IOU, and in this case it's a discount bond. So the Bank of England, through an intermediary, will issue this IOU with a face value, as you can see here, of £100. Now this it matures in 1 year in our fake scenario, so the investor might well pay £90 if interest rates are around about 10%. So today, £90 to the Bank of England. Bank of England issues the bond, or we can call it an IOU, that you can be being redeemed for £100 in exactly 1 year's time. So you've made 10 quid. So what I'm saying here is promise to pay you £100 in 1 year from now. Great, I will make £10, says the investor. Right, so I make 10% on my bond investment, but I can only get 8% on my savings account. So I'm very happy with that investment. Let's go ahead. Now, 6 months later, the investor, he needs his money back early, so he can ask a broker in the secondary markets to give him a price. So the bond brokers will be constantly matching sellers with buyers throughout the life of a bond. So at maturity, we know that it's going to pay £100, and the change in the price of a bond will happen when interest rates move in the normal environment. So the Bank of England base rate and the various rates that follow on from that. Now the reason for this is, of course, the bond is fixed, so you'll get a fixed amount in whatever period of time. So in this case, there's 6 months left until the bond will mature and the Bank of England will pay out £100, whatever it's sold for in between. So in this case, he's paid £90, but he can only get £80, and that's because interest rates have risen. So the investor will lose £10 on his investment. Now, the question is, why have I lost money? So you bought the bond when interest rates were 10%, and of course this is very exaggerated examples. We're only talking a few percent under normal circumstances. So interest rates are now 30%. So any buyer would want to make, over a 6 month period, would want to make roughly half of 30%, so that's 15% obviously. So the alternative for the investor is to hold on to the bond for 6 more months and receive the £100, making a profit of £10. Or he can sell the bond in the secondary market and lose £10. So he's effectively selling a 6 month bond that pays £100 in 6 months' time, for which you paid 90, or the investor paid 90. So interest rates have now risen to 30%. The new buyer wants to gain 15% at least over 6 months, which is half of that 30. and a new buyer therefore will pay a maximum of £85. The broker will take a spread, and I've just made these up, but obviously they need to make money when they do business. So he's going to take a spread to cover his risk and profit of £3, and then the broker will take maybe £2 off in order to attract a buyer if there aren't enough buyers in the market. So therefore the liquidity is less. This is important for later on. So the takeaway here is if interest rates are expected to rise, or even people think it might rise, there may be few people willing to buy unless the price is low enough to cover the fears of those expectations. Right, so this is a discount bond. In our discussion, we used a simple example. A discount bond pays no interest, and so they are sold cheaper than the face value, and our investor obviously pays £90. This implies an interest rate of around 10%. So the roundup, in our discussion of bonds, with a simple example of a discount bond, it pays no interest, and over the longer term, bonds which mature and pay back your money mostly pay an annual interest rate, or coupon as it's known as technically. So that's the payment you'll get every year. So for example, if it's a 20-year bond, then every year you will get a percentage return, and then obviously when the bond then matures, you will get the full face value of the bond back. So because bonds are a fixed rate, when interest rates go up, bond prices fall, and vice versa. Insurance companies use coupons to pay out their pensioners as they retire by holding a very large number of bonds in a portfolio, and they are structured in such a way that they're constantly receiving cash flows which then they will pay out to their pensioners. Right, so how do we protect against an adverse change in interest rates? Well, there are contracts which are referred to in the financial markets as instruments, and they're available to protect your cash flows against changes in interest rates, so known as interest rate swaps. An interest rate swap can be fixed for floating, and fixed on various different indexes or set barrier levels or whatever. They can be structured in the over-the-counter market. They will be sold with the specific details negotiated with the pension fund, and typically the financial institution will be an investment bank or a trading house. So we're going to make a very simplifying assumption here that the pension fund will pay the bank if the yields on the bonds go above 2%. So that's the even though it's a fixed interest rate, there will be yields will change depending on prevailing interest rates, and then when the when the rates drop below, or the yields drop below 2%, then the pension fund might have difficulties meeting its liabilities to its existing pensioners. So what happens in this case is the financial institution will then pay cash flows to the pension fund, which will support that risk. If we look at this in a slightly different way, the interest rate swap can also pay when the effective yield on the bond falls to this pre-agreed barrier level. And when interest rates are low, obviously the pension needs a top-up in order to meet its liabilities, i.e. the pensioners, and then obviously this ensures that the funds are available. When the bond yields goes above 2%, there's got to be two sides to this contract, otherwise the financial institution will always lose money. So typically there will be an upper barrier. So when the bond yield goes above that, the pension fund doesn't need the excess, or would like the excess but doesn't need it, and so that excess will then be paid back to the investment bank, and that's kind of how it works. So what went wrong? We've got this, I've put this chart here, and it's showing that from around about December 2021 there's been an upward trend in the this is actually the yields of the bonds, which means the bond price is actually falling, but the yield is increasing. And then obviously when that yield passes a certain level, the pension fund will then have to start paying cash to the financial institution. And of course, we've had lots of problems in recent years, so starting with the pandemic and then the lockdowns and then the coming out of lockdowns. So these have been important factors. We've obviously had to do furlough for people, and the government has had to raise money in the bond markets more than they would usually do, and certainly more than expected. So that's been an issue. Coming out of the lockdowns, there's been supply chain issues as different parts of the world come out of lockdown at different points in time. And in some countries like China, for example, they are still locked down in areas, or definitely subject to being locked down at short notice. Then of course we've got the unfortunate war in the Ukraine, and this has been a serious issue because of the sanctions raised against Russia, and therefore commodities such as oil and gas have rocketed in price, and this has led to this cost of living crisis. So we can see then over this period of time, and definitely through March, it's just continued to go all the way up with a little blip here, but the trend, as you can see, is upwards towards 4%. This blip here, which happens over a very short period, that's unusually large, and that followed the mini budget where the Chancellor said that he intends to cut taxes, but has thus far not told anybody, including the markets, how that's going to be funded. That creates an uncertainty within the markets, and then people look for less. Any uncertainty obviously creates risk, and then people will look for less risky assets, although there aren't many around the world at the moment. Probably US Treasuries. So what went wrong? In this sense, after breaching the swap levels, obviously the pension funds had to start paying cash flows. But they don't just pay cash flows. Once this situation develops, we've got a secondary payment that the pension fund has to send to the financial institution, and this is called the collateral margin. And that indemnifies the bank or financial institution from default. So if the pension fund finds itself in a position where they can't meet its obligations, then that's a default situation. And to indemnify themselves against that, they will ask for collateral, much in the same way that if you get a mortgage, the loan to value rates, the house is the collateral, and if you stop paying, they can use the house then to recover losses. Right, so this is the crux of the matter. Pension funds have had to start selling its bonds before maturity to meet its obligations for the collateral and yield related payments on the swaps, which are derivative instruments. So as all pension funds are in a very similar position, they've all needed to sell at the same time, and this then lowers bond prices from the supply and demand side. So the brokers are trying to match the sellers with the buyers, and there's fewer buyers than there are sellers, and so they have to drag that price down a little bit to encourage somebody to then buy those at a kind of bargain price. If it gets much worse than that, it's called a fire sale. Now, why did the Bank of England have to step in? So we've got this vicious circle that's developed, and this effectively summarises the market at that moment in time. So collateral and payments increase from the pension fund to the bank. They have to sell bonds to meet these payments. Selling the bonds causes the bond prices to fall. Then that causes the bond yields to rise, and then the collateral and payments increase again. And then we've got this circle, which if it's not stopped, it's a vicious circle. If that doesn't stop, then eventually the bond markets will collapse. But there will be no buyers, and everybody trying to sell. So is it the government's fault? Well, not really. So here you can see headlines of 65 billion scrambled to avert financial crisis. This was from The Guardian, but similar across all media outlets. We've seen this steady rise over the past 12 months, and at some point it was probably likely that the Bank of England would have to intervene, as Japan's government already has done a few weeks earlier. The government's mini-budget didn't provide any detail on how spending plans would be funded, which that obviously is going to make the markets nervous. Their view will be how much debt is the UK prepared to sell into the market. And obviously the more indebted you are, then it increases the risk, so that at some point you will default. Now, this is absolute nonsense, because the UK have never defaulted on its debt, even through the Napoleonic Wars, the First, Second World War, and major crises, 1929, etc. There's been a couple of, people will raise a couple of things. There's been a couple of technical defaults, in the sense that around about the 1929 period, German reparations to the UK from the First World War stopped, and those were basically passed through then to pay off the loans from the US. I wouldn't call this a real default. This was a global problem. So in actual, whatever the rating agencies rate UK gilts, they're AAA plus, and for hundreds of years, through all kinds of crises, the UK government has never defaulted. Right. The mini budget provided this safety net for energy prices. This was essential for a number of reasons. Obviously, it's good that the consumers will be helped, and particularly vulnerable consumers and businesses, who would just effectively go out of business if this help wasn't there. So it was critical, and nobody can criticise that. But also the secondary effect of that is when you cap the energy prices, you're effectively capping inflation. This inflation that we've seen over the last 12 months has been, certainly since February, when Russia invaded Ukraine, has been the main cause of the rocket in inflation. Not the only cause. The lockdowns and supply chain issues also caused inflation, but to a much lesser extent. So they've got to get this inflation under control. And one way of doing that, or a very good way of doing that, is to put a cap on energy prices. A little bit of pain, it's got to be paid back. We don't know yet how it's going to be paid back. We think it will be that the prices will remain elevated when energy prices fall for an extended period. So we'll be paying the same as we do today for longer than is necessary. And this, in a sense, that's like how an interest rate swap tends to work as well. We'll underpay now and we'll overpay later. So effectively, it's kind of a loan. And I think this is a reasonable thing to do, because it helps people out now. And although energy prices obviously will remain higher than we want them to be, they're just about affordable, apart from the most vulnerable, who should be getting help anyway beyond that period. This nervousness in the markets obviously very quickly translates then into so they do say that the mini budget was the cause of this blip, and it probably was, but it was an overreaction in my view. So to look at that, what taxes have really been cut, right? So the actual tax cuts have been income tax 1.9 billion. I've made that estimate, but we've seen all sorts of wild estimates for the total package, up to 60 billion pounds, and even more for energy. And then scrapping the proposed increase in taxes that Rishi Sunak brought in. And I have put that as 1.25 billion. Corporation tax, I think it's less than 7 billion. But 6% non-tapered across the current corporation tax bill comes to about 7.2 billion. And it is tapered. So basically what I'm saying there, it will be less than 7 billion, possibly as low as 4 billion. So that gives us a total 11.05 billion. Now this is a lot lower than what people are talking. They off the top of their heads, they're talking 40, 50 billion. They don't tell anyone what the assumptions, the base assumptions were. And so we've got a range. In fact, I think the CEBR are now saying that the energy cost will be about 30 billion rather than 60, and so on and so forth. So the tax cuts, yeah, nobody likes a tax cut in the markets. Well, perhaps except the bankers' bonus cap, if they don't know how it's going to be funded. So we don't know that yet, and there's going to be an independent OBR analysis. So would this increase in tax cause bond market chaos? Normally not. Even if the cuts were 40 to 50 billion, which I think are vastly over exaggerated, some are just saying that it was a straw that broke the camel's back because of all the increased borrowing over the pandemic. And others are saying, no, this is just an overreaction. But these things become more sensitive when it's a problem across the globe. So with Japan having problems and issues, Europe are going to have probably quite large issues, especially Germany, throughout the winter period, and so on. There's a general jitteriness within the market. So any small bits of over-exaggerated news or things like this are bound to have some effect. The mini budget, I think there's an overreaction to that, but I think there was a build-up of pressure up to that point, and at some point these things do tend to fall into disrepair, to say the least. So my conclusions are, we are living through tough times, and we've had this global pandemic, perhaps an overreaction to that, very conservative at the very least, and then this war, which is having a direct and significant impact on energy prices and therefore inflation. The increased indebtedness of governments to levels over 100% of GDP. This is new to market participants, and the benchmark is 60%. Any debt above 60% is said theoretically to put a drag on growth. Now, I don't necessarily believe that. I believe in that principle or the principle theory, but yes, there will be some effects. We don't want it to be that high, but we can manage that quite well. In the UK, Debt Management Office tend to spread their debt over quite long periods of time. Will the markets return to normal? Yes, definitely. The Bank of England have stepped in. They have acted as buyer of last resort, which is their role, and that's put stability back into the marketplace. They may have to buy more. It's unlikely though. As long as the markets know that the bank will step in if necessary, then the fears will be removed and therefore the panic. And we've seen that already. There's a drop back to 4%-ish. Next few years are going to be difficult ones in terms of interest rates. They are likely to rise, probably 7 to 8%. We've still got quite a lot of, we've got about 900 billion of QE, which is the quantitative easing package of bonds that the Bank of England have bought. And to do that, they've credited that amount of cash into the economy. This normally has an inflationary effect, but over the last 7 or 8 years, it's not been the case. And in fact, we've been moving more towards deflation, which is much, much worse than inflation. House prices are likely to fall, yes. Exchange rates will remain weak until inflation is under control. Nobody can put a real time scale on that at the moment. So probably a good idea to batten down the hatches. Right, I hope this has given an insight. You may not agree with me. If not, that's fine. But this is my take on it. Thanks for watching.